Sikshayati, platform for eminent authors, engaging teachers, successful students. To know more, email. Bank accounts. Bank, an institution, acts as a custodian of money. It receives deposits from public, lends to public, and invests them into different funds. Bank maintains several types of accounts suiting customers' specific needs. Savings amount can be deposited at any time or withdrawn for a limited number of times. Interest is paid by bank to the customer on this type of account is comparatively low. Fixed deposit. Amount is deposited once for a fixed period. Interest is paid periodically or on maturity. Highest rate of interest is paid on this type of account. Recurring deposit. Amount is deposited at regular intervals. Interest paid on this type of account is higher than savings account. Current. Amount can be deposited or withdrawn at any time and no interest is normally paid on this type of account. Bank even charges a certain amount on this type of accounts for its service charges. Generally, business concerns open this type of account for their day-to-day transactions. Bank book and passbook. Bank book. The customer maintains account of bank in its own books. Bank book or cash bank book, which shows all the transactions with bank and the balance lying with bank. Passbook. In the same way, bank also maintains the account of the customer in their books. Customer ledger account in the books of bank, which shows all the transactions of the customer with the bank and the balance lying in customer's account. So bank book and passbook denote same set of transactions between the bank and its customer in each other's books. Matching the bank book and passbook. The transactions shown in these two sets of book, that is bank book maintained by the bank customer of the transaction with bank and passbook maintained by the bank of the transaction with the bank customer, refer to same transactions occurred between bank and its customer. So they are mirror reflection of same transaction in the books of the bank and bank customer. So the transactions recorded in bank book and passbook should match. Consequently, the bank book balance and passbook balance should ideally be equal and opposite on a particular date. So the debit side of bank column of cash book must be exactly equal to the credit side of the bank passbook. Similarly, credit side of the bank column of the cash book must be equal to the debit side of the bank passbook. But in practice, these balances vary, that is, do not match due to several reasons. To reconcile the difference between bank book and passbook, bank reconciliation statement is prepared. Bank reconciliation statement. When bank book and passbook do not match, the unmatched entries are compiled and bank reconciliation statement is prepared to ensure that though the bank balance of these two books do not match, the entries of the two books agree and the difference is explained, that is reconciled. Bank reconciliation statement shows the itemized details of the differences between cash book and passbook with suitable explanation. Bank reconciliation statement enables to detect errors that might have crept in the bank book or in passbook, omissions of entry in any of the books. It also points out the delays, that is floating period of collection of checks. Bank reconciliation statement is not a part of double entry bookkeeping system. It is just an internal control system to establish accuracy of cash book balance. It can be prepared when bank statement is received from bank. Thank you for watching the video. Kindly write your comments. Click on the red subscribe button at the bottom of the video to get more details and free ebook. Email us.